This is Investing Ideas by ValueinvestAsia.com.
Welcome to Season 2 of our Investing Ideas. I'm Stanley. This week, we chat with Brian Halim, a Singapore-based investment blogger. Brian has been an active investment blogger in the Singapore market for the past decade and has really become a key opinion leader for retail investors interested in investing in Singapore. Interestingly, Brian has decided to move out of his comfort zone this time around for our interview and talk about a fast-growing tech company listed on the Australian Stock Exchange. So this is our discussion with Brian on Xero Limited. Here we go.
From ValueinvestAsia.com, this is Investing Ideas, where we talk to investors from all walks of life, learn from them, and find out some of their favorite investment ideas.
So welcome, Brian. How are you?
Hi Stanley. Thanks for having me on the show. I'm very excited today.
Thank you. I'm very excited also. Yeah. Before we jump straight into the investing ideas that you want to share with our audience today, we want to have a small chat with you first. Why don't you share with us what's your background in and why do you end up choosing to become a financial blogger?
Yeah, sure. So I'm actually came from an accounting and finance background. So throughout my professional career, I've been in the accounting line. I started from a big four accounting firm, and then I moved to an MNC. And then now I actually for this year I actually moved to a startup firm, which basically is a kind of a new challenge for me and give me a whole new perspective of how to look at companies. So I think it'll be interesting to talk about this company that I will be talking today.
Right. Okay. So you actually moved to a few industry before, like a different type of company. And in your work right now in a startup, what are you focusing on? What's your role inside the startup?
Yeah, so I mainly basically I'm the head of the finance in this the startup firm. So my role is the typical maintaining the book, making sure that our numbers are looking good, budgeting, raising funds to investors. So of course, while talking to our investors, then I kind of also had a clear look exactly what investors are very much looking into, the typical key metrics of a startup firm, which is what I'm going to talk about later.
Ah, okay, that's interesting. And why did you end up starting your own financial blog? What's the motivation behind it?
Yeah, I actually started it writing it about maybe more than 10 years ago. So I think
Yeah.
it's the key back then was then to just journal the whole idea about financial freedom. And of course, financial freedom, it can be more than just personal savings alone. So I started writing about personal finance, but also analyzing companies, um, which I am basically interested in, and I wanted to put my money where I talk about in the blog. So that's where I started to kind of analyze companies, meet people, and yeah.
Right. Okay. And also, you have a very interesting feature on your blog, which is that you actually present out your own portfolio within your blog, lah. Right.
Yes.
It's a very sizable portfolio. Congratulations on that. But I can't help to notice, right, when I'm checking out on the update, you're actually holding on to a lot of cash right now,
Yeah,
right?
yeah, I am.
Why is that? Are you quite pessimistic about the market?
Generally, I just feel like I cannot find a really compelling idea, especially because most of my investment in the past few years has been in the Singapore market. I haven't really got a chance to look and venture out of the Singapore, but of course these days I've been looking more into the Hong Kong, China, and also the US market. But generally, I think overall the price has been valuation has been on the upscale when we compare against the future earnings. So I guess it's a better time to wait, in my opinion, until there's a little bit more blood on the street where there's a low hanging fruit to pick up from.
I see. Okay, okay. That's fair enough. Why don't we jump straight into the idea that you have today? It's a very interesting company, one that I have owned it in the past for my family portfolio as well. But why don't you introduce this company to our audience?
Sure. So the company I'll be talking today is then called Xero. So Xero is the reason why I first chose this company was because it's also outside my circle of competence. I don't usually analyze tech companies, especially in the US. But since I started out working in my this current startup firm, I thought, why not give it a shot? Something more challenging, something more interesting, right?
Right.
So the reason why I chose this company was mainly because the financials are not looking great if we take a look from an overall traditional P&L point of view. And of course, then in this discussion, I wanted to debunk that myth that a company that is making loss right now does not mean that it's not a good company to look at. And of course, then Zero and of course a few other tech companies comes into play. So this is the reason why I wanted to choose Zero to talk about.
Right. Okay. Of course, Xero is listed actually on ASX on the Australian Stock Exchange. It's accounting software services, I would say, right? Do you
Yep.
agree? And yeah, why do you like this company?
Sure. So let me give a brief introduction about this company. So this company is basically like you mentioned is a cloud-based accounting software platform. It started off in New Zealand but listed in Australian Stock Exchange. It's an accounting software which is mainly used really, by a lot of startups, small or even medium-sized enterprises. So
Right.
I guess if you are a accountant and you're working in a small or medium-sized companies, I think you must have heard of Zero because of course, there will be other competitors which I can talk about later.
Mm-hmm.
But I guess the biggest advantage of Zero at the moment currently as a software
Mm-hmm.
is its ability to integrate with a lot of other external applications into the software. Um, so if you're trying to do a certain report, you are able to actually integrate it with that particular external software, which most other accounting software which I've used in the past,
Mm-hmm.
small, does not been able to do that.
Right. So you can actually link it with some external software that you're using. Can you give an example in your own experience? So, how did you like combine Xero with other software that you're using?
Yeah, so actually, it's, if you're trying to, for instance, here, if you're trying to pull a report and try to link it with even with your some of the in-house operational system, or for example, let's say an Amex card, for example, right, that you use for your company's expenses,
Mm-hmm.
you are actually able to link the card together into your system such that if you incur any cost on your business cards, that expenses will actually go automatically inside your Zero system instead of having you to key in manually how much you spend this today and tomorrow and following after that.
Right. Okay. So it like save a lot of time on the bookkeeping side of things.
Yeah,
Right.
that's right.
I remember because when I'm starting up on my own company, also I'm using the bank UOB. They also provide a service where it can link my UOB bank account with Zero directly if I want to as well.
Yeah,
So
that's right.
they just work with a lot of other partners to help you automate some of the bookkeeping systems lah. Would you say that?
Yep, that's correct.
Okay, okay. But how is that different from, say, any other player? There's quite a number of, I guess, cloud-based accounting system out there, even locally. So what makes it Zero special?
For me, I've when I try to look at, especially just in Singapore, right? It's not used worldwide. I guess cloud-based accounting software is not very much common in Singapore yet. There's a lot of much smaller players, a desktop kind of a software. So if you look at the um, EggPack, MYOB in the past,
Yeah.
even the very basic QuickBooks, etc. All they did was really a very simple accounting software, which then allows you to key in your typical bookkeeping and manual journals, but then it doesn't allow you to first integrate with other platform. And second, all your information is then not stored on the cloud, basically.
Mm-hmm.
So if you want to retrieve after that, it will be kind of difficult.
Right. Okay. Okay. And for cloud-based one, are they already the biggest? Maybe globally or maybe in Asia Pacific, or why don't you
Yeah,
share a little bit about some of their
sure. I
competitor?
think sure. I think some of the competitors, if we're just looking at the Asia Pacific, there, I think Xero is a one which is a lot more dominant, especially if you look. If we especially if we include Australia and New Zealand inside the bigger Asia pack in a way, um, in Southeast Asia alone, a lot of almost I would say 70 to 80% of the small and medium enterprise still uses Xero.
Mm-hmm.
There are others in play, such as Financial Force, NetSuite, Oracle, which I've a little bit experience into it.
Okay.
But I guess the overall structure of the software is still very much into Zero.
Ah, okay, okay. And you talked just now a little bit about how do you look at a startup firm, some of the matrix that you look at when you analyze such a company. You want to share that with us? How do you analyze such a company compared to a traditional type of company?
Sure, sure. So if we look at the basically the very traditional P&L of this
Mm.
company, right?
Mm-hmm.
Um, if you are someone who comes from a traditional background and you look at and you look one glance at this P&L, you'd be disappointed, right? Because every the rate basically, right? Apart from the top line, which obviously is growing because they are in the growth phase,
Yeah.
but apart from it, everything else is in the red. So I have friends whom I show this spreadsheet, and then they told me within 5 seconds, like this is not a company I wanted to own, right? Because why would you want to own a company that's making net losses year after year, even after like 12, 13 years of
Yeah.
operations? Yeah, so even from a free cash flow point of view, it's still also all in the red. So it's but again but again, I think this is not the way typically on how you measure and read and analyze a tech company. So if you wanted to look more in the detail, you can actually look at one of their notes in the annual report, which actually shows some of the key metrics for a SaaS type of companies. So
Okay.
what they did here was basically they kind of track the main a few things. And then the first is then the number of subscribers they have. Obviously, that's gonna impact their top line numbers.
Mm-hmm.
But more than just the number of subscribers alone, they actually goes into the details of how they break down specifically into their CAC, which is then stands for a cost of a customer's acquisitions.
Mm-hmm.
It's, of course, the customer of cost of acquisitions typically made up of more than just your typical selling and marketing, but also includes a typical operational cost where you basically tells you how much the company is willing to spend in order to convert from a potential to an actual customers. So
Mm.
if you look at the numbers all the way from the early days until now, the numbers have actually been quite constant. It is the cost of the acquisitions. If I look at the numbers here, is about like $377 per subscriber,
Mm-hmm.
about $400 per subscriber.
Right. So
Yeah, and
those are the marketing costs to get one customer on board, right?
that's correct. That's correct.
Mm-hmm.
I think the one of the important key of Zero is that actually once a company start using Zero,
Mm-hmm.
it's actually quite sticky. You don't actually change accounting software year after year, because
Yeah.
you want to keep one where it is stable and be there for years until the. So what we do here is that then the company typically tends to compute what they call as the lifetime value of the customers, the LTV,
Mm.
on a subscriber basis. So once the customer acquire this new potential subscriber into their company, they then compute how many years will then this subscriber stay in the company um, in their lifetime, right? So if we look at this metrics, the numbers is actually has grown from 1,700 5 years ago to 2,400 in 2019. So if we look at the ratio, which is then the LTV over the CAC cost, is actually around 5 to 6 times now, which means for every single customers that they bring,
Mm-hmm.
uh, they actually able to make 6 times in throughout their lifetime.
Wow. Okay. So that's definitely quite impressive. Given that in 2015, I'm just looking at your table here. 2015, the lifetime value to the cost of acquisition is only around 4+ times, right? So they have also improved that, and also while maintaining the cost of acquisition. Pretty impressive. But let me be a devil's advocate here, because when you say that accounting software is very sticky, which I agree, because we started out on our accounting software, and I find it really hard if you want to migrate to another one. But wouldn't that also means that it's very hard for them to penetrate to, let's say, existing companies who already have some software? It's hard for them to penetrate that market and ask people to switch to Xero.
Yeah, I think that is one of the main risks, especially if the company is trying to break into a different vertical. That means they are trying to go not only targeting the small and medium enterprise, but let's say one day they wanted to grow bigger. They have a product which is ready and try to break the higher, I mean the larger type of companies. I've worked with companies, bigger companies in the past, and typically they use SAP or Oracle Hyperion in order to. That one has a totally different scale. They have a large base of modules that's able not only to integrate your typical accounting, but also like things like payroll, other expenses, budgeting, forecasting, operational. So I think the larger players is definitely harder to break into. I would think they would rather go geographically and try to penetrate the more startup kind of firm globally.
Right. Okay. Okay. But it also have do you have any data on, say, what is their biggest, that their customers range, like is it from startup to how big of a company that they can serve? Because you talk about a lot of enterprises, they would just use some of the bigger guys like Oracle or SAP. Would they have a risk like, today I'm a startup, I might start with zero, but as my company grow and become much bigger, sooner or later I have to migrate to accounting software by the big guys like SAP or
Mm.
Oracle. Is there such a
I
risk?
I think there is and but then I think the reason why Zero is so attractive at the moment is because their pricing package today is very competitive in my opinion. So if you look at their what they offer today, their pricing range starts from $20 per subscriber based on the starter,
Mm-hmm.
and then $30 based on the standard, and then $40 based on the premium,
Right.
which is actually very affordable for a startup or medium enterprise.
Yeah.
Of course, they are Zero is also trying to do a lot of enhancement to their product. So, for example, last year they actually bought a Hubdoc, which is then a software application in order to integrate a lot of the main administrative tasks that you can integrate together in at Zero.
Mm-hmm.
And they're actually only increasing the pricing package by $2 uh, from next year onwards, from
Right.
2020 onwards. So I think there's a lot of enhancement that's being done to the product as the software tries to grow even to the SAP type of a scale. But then again, the price is then will be a main factor for any startup or medium enterprise firm.
Right. Okay. Yeah. Sounds very very interesting. Uh, what do you think of their profitability going forward? Because you mentioned they have never really been profitable. What's your view on that?
Yeah, I think if you look interestingly, even though they have not been very profitable, but if you look at the trend, and if you look at just now the key metrics, which is measuring the LTV over the CAC, it is actually very promising indeed. So they started off with a lot of costs. Even back 5 years ago, their operational costs are up until 156%, which means they are typically making a net loss margin of 56%.
Mm-hmm.
But if you move into all the way 2018, 2019, we can look at it slowly churning down the loss. So in the 2019, their net loss is actually only 4.9%, which is actually very small.
Mm-hmm.
And I think there's a good chance that in the 2020 or 2021 that they might even go back into the black finally after like 12 to and 13 years of operations.
Mm.
Look at the Hubdoc acquisition and the increase in the pricing premium from March 2020 onwards next year.
Mm-hmm.
If we take a very conservative value of $2 increase in the package, multiplied by the number of subscribers they currently have in their books,
Mm.
that alone would give them about like how much 30 around 30 over millions in a year. So I guess,
Additional. Mm.
yeah, in addition, so I guess that alone, that enhancement alone will likely bring them back in the black, assuming all numbers are constant or
Mm.
equal. But I
Mm-hmm.
guess they are already going into that direction where the management has guided for a stronger cash flow. Even at this growth phase, they wanted to be back in the black as soon as possible.
Right. Okay. Okay. That just you mean just looking at the trend, they should be looking into becoming in the blacks as they continue to grow. I saw that also from their cash flow from operation, they happen to finally turn the cash flow from operation into positive as well. So that's a pretty good sign as well, right?
Yep, that's exactly. Yep.
Okay. Okay. And so looking at it, so what could be the risks for this company? What do you think?
I think the risk is basically just now we already touched briefly on it. So I guess a lot of the risk is because they currently focus a lot of on their small and the medium enterprises.
Mm-hmm.
So like you said, so it's the first is the probably their inability to penetrate into the larger companies, which of course larger companies means they have a larger budget, which means then they typically want a much comprehensive modules to have in the software, right? Um, but I think secondly, we have to really look at the economies as a whole. I think companies like Xero, which obviously target small and medium enterprises, they kind of thrive in an environment where uh, basically the economy is looking great. There are more startup firms coming up. It is easy to get, and of course startup means easier to get funding and so on and so forth. So in a scenario where let's say we have a recession, right, and a lot of companies are asked to cut their budget,
Mm.
or even the startup firm are getting difficulty in trying to raise funds to investors. So all these things will then, of course, then impact Xero, because their number of subscribers, not only will they have to be a little bit stagnant, but also there is a potential where the number of subscribers could actually go down because of all these risks, which we have not seen really yet in the past 10 years. Yeah, and,
Okay.
and I think the other risk is of course regarding the cash flow, right? I mean they are technically already public listed, so
Mm-hmm.
in a way, they cannot, and they must have they must eventually go into a positive free cash flow, because if they don't, a few years down the road, that will mean a lot of burning on the cash, and then they will one day have to then raise funds to investors, which is typically not very nice.
Yeah. And talking about that point, how's their balance sheet looking like at this
So
point?
the balance sheet is okay. It's nothing much special, because they are also trying to grow,
Mm-hmm.
and also a lot of the acquisitions like the Hubdo, for example, they actually capitalize the the cost. So a lot of their cost goes into the depreciation, especially very upfront accelerated type of depreciation.
Right.
Yeah, so I think the balance sheet looks okay at the moment, but then we hopefully this does not goes down throughout the next 10 years where the company is still cash burning.
So they're not like very highly geared, or they don't have a lot of debt on their books, lah.
Yeah, they don't. It's okay. Yeah.
Okay. Now the burning question. I quite agree with most of everything that you said on the growth prospect of this company, but I think a lot of investors will be stuck at this point, which is valuation.
Yeah.
How do you value such a company and looking at it?
Yeah, so for such a company that is basically not yet profit making, so I mean, typically a traditional company we will do as a very simple multiple valuation on the price to earnings, but then because this one has no earnings, in a way, so it doesn't make sense to do price to earnings, which we then go up into how much does the company grow their top line at. And if we take a backward method of valuing this company, so the market cap today of Xero is worth about 11.4 billion, which and today's share price I think is about $80 per share. So if we do a quick mathematical computation, this would imply a sales turnover of 20 times the top line numbers.
Yeah.
And 20 times top line numbers is actually pretty high, because if we just typically take a very simplistic 20% margin on the earnings, so let's say the company goes into the black next year, and the company makes a 20% net margin, a 20 times turnover multiples would simplify about 100 times price to earnings. So I think it's a very very high, and to be such a high valuation, in my opinion, you really have to justify the kind of a potential growth that the company is still growing.
Right. So at which point would you personally become like interested and when willing to invest in such a company?
I think typically within 8 to 10 times would be pretty fair. Actually, the start of this year, before the company rise to today's price, is actually quite fair. And it is only like today, 12 months down the road, where we see the company grows their top line by 31%, and but the share price has goes even much higher. That I do feel from a valuation perspective is a little on the high side. Of course, that doesn't mean the company cannot grow. I would think once the company goes into the black in the next 1 or 2 years, then the market will be probably valuing it much higher. But I
Right.
guess we always wanted to have that like a margin of safety where we don't overpay.
Yeah. So you're basically kind of saying that if it's around 10 times sales, it will look interesting to you,
Yeah, I think
right?
typical. If I have a quick data list here, a graph where a typical SaaS type of companies publicly listed. So if you are at around 10 times your turnover multiples, you are typically should grow at about 30 to 40%, which is exactly what Zero is currently
Right.
growing. For you to justify turnover multiples of 20 times means you had to grow at about 60 to 80 times, 60 to 80% revenue growth rate, which I think at the moment Zero will not be able to do so from a year to year point of view.
Okay, yeah, I'll show the graph out for everyone to have a look. But I do have a question as well on this company, because at the end of the day, although it's fast growing and definitely a very useful software tool for a lot of company and especially startup, they are still considered like almost like a one product type of company, right? So if you compare it with other SaaS company like your Dropbox or Slack, which is one product but doing it very well, do you think they will also struggle alongside with company like Dropbox or Slack when the big guys start to realize that this is a profitable market and we want to attack it? So like Google with their Google Drive and also
Mm,
Microsoft now with Microsoft Team,
yep.
uh, would you see Xero facing such a big problem? And do you think they will still come out all right if such thing happens?
Yeah, good question. I think if for me the key is really then to look at the company's economic modes, right? I think if we compare it against a Slack, for example, right? They started off very strong in this chat applications software. But then if we try to take a holistic view at it, right? There is a lot more competitors in this space versus what the in the accounting software type of where Zero has a mode at. So I don't know. For me, for example, in my company, right, we use like we also use Microsoft Teams, and we also have a Microsoft package bundles where we typically have access, PowerPoint, Excel, and all these things, right? So the way Microsoft penetrate the market is more of like they're trying to sell overall as a bundle, which then of course includes Microsoft Teams. While Slack is in the space whereby it's a very traditional type, very one area where it sells your chat box kind of a platform. And 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 to me, I personally don't see the need for a company to have that. uh we always have other alternatives that we can use, right? Even within the company itself. So Microsoft Team, Google Hangouts, or Skype and things like that, which is
Yeah,
a lot free.
yeah,
So for me, as a finance, if let's say one day I have to really cut budget, and I have to pinpoint out where I think the company could cut my budget on, I think Slack will be one of them, because I just don't feel that it is that, it doesn't have that importance, number one space on my list, whereas
yeah.
companies like Zero, correct. I think other big players might come into the play, but then I think it's not as easy to penetrate as opposed to companies like Dropbox or Slack.
Right. Uh, Let me challenge you on that part a little bit, Brian.
Yep.
Because I'll give an example. Because last time I used to, I write all my notes on digital notes. So in the past, I used this app called Evernote, right? And I use it for very many years. But when my Microsoft Office 2010 just expired,
Mm,
or then I try to renew a new one, so I end up signing up for Microsoft 360.
mm,
And within the 360, they provide everything, including Microsoft OneNote, and they have a one-click export from Evernote, because they know Evernote is their biggest competitor for the note section, and it's almost seamless, right? It's just one click. I put in my Evernote account, and then they port everything into my OneNote directly, and it's like I never left. And from then on, I stopped using Evernote ever again, because with my 360 subscription, my OneNote is I have a
mm,
much
mm.
larger space. Would that also happen to Xero at a point where maybe Oracle or SAP find out how to export their data completely and seamlessly, and then SAP will say to the guys, say, hey, we can have a one-click export of all your account from Xero, uh, and then everything will be pumped into SAP as the company grow, because they might need SAP ERP system or other systems. Uh, wouldn't that also wouldn't that might happen as well?
Yeah, yeah. Actually, SAP has also, if a company has already been using SAP or Oracle, right? Actually, a lot of the modules which Xero currently has, they also have it. So it's actually not a fair comparison, because obviously they are a much larger scale, and they basically has everything Xero has today, I think, except yeah, I think pretty much like that. Even from an integration, from a UI UX perspective, everything else is better. But I think the key is then, SAP actually price their subscription a lot more expensive I cannot recall on top of my head how much, but I think it's about 150 on a per subscriber basis. If you want to have access, that's how much they charge. It's very costly for them.
Yeah.
Uh, it's unlikely for SAP to penetrate into the smaller market at the moment, because obviously from a budget wise they cannot. But I agree, like you said, if let's say one day they are able to price it affordably and they are able to have a one click system where typically an accountant, all they need is just a report, right?
Yeah.
They don't really care what software to use. If they're able to do that, then for sure they are. But I think one of the board members of Xero is actually a guy from MYOB. So MYOB
Right.
is also some a very good accounting software used
Yep.
typically by smaller firms in the past, and a few history here and there. So I think they do have a lot of experience on the management. They are not new. They are someone who's been exposed to these, their competitors, and so on. So I think they'll be wary of this, like you said, the risk.
Right. Cool. Yeah, definitely a fascinating company. And I'm actually quite surprised when I chat with you and you say that you want to present this company, because from following your blog for quite a while, this is definitely not a typical company that you look at within your blog lah.
Yeah. It's not in the past. It is not in the past, but I
Yeah.
think it's interesting to follow the space of a very high growth, a very interesting space where a lot of these new tech SaaS company can really break through to become
Right.
the next big player.
Okay, wow. Okay, thank you so much for your time, Brian. Once again, this is Brian Halim from treeforeverfinancialfreedom.com. If you want to check out some of his writing and his blog, I'll put the link down on the show notes. He recently, I've been reading your report on Straco Corp and what you think of the company. So definitely, if you
Yes.
want to know more about that, do check it out. Thank you once again, Brian. Thank you for your time.
Yep. Thank you. Thank you, Stanley.
Thank you for listening. You can subscribe to our show on Apple Podcast, Google Podcast, Spotify, or wherever you get your podcast. If you are feeling generous, please give us a rating and review as well. This would greatly help other investors find out about our podcast. To access our show notes, please go to valueinvestasia.com/investing ideas and be sure to sign up for our email newsletter for more outstanding content and reports about investing. The show is for entertainment purposes only and should not be taken as investment advice. Please seek professional advice or do your own research when making any investment decision.